Weekly sense, Carl. Our
Yeah,
first collapse of a bank in this business cycle.
right. Yeah, we haven't had a significant bank failure since the 2008 financial crisis. So it's interesting to see that. We're looking at that carefully, and a lot of people are.
Yeah. So for those of you who haven't read the newspaper today, Silicon Valley Bank just got taken over by the FDC. So
FDIC.
or FDIC, yeah, FIC. And Silicon Valley Bank, obviously in the name, primary lender to a lot of technology companies. But now you're actually starting to see some weakness in some other regional names because of fear of contagion. So I think is it First Republic was down pretty big today as well as yesterday.
Right. The other ones that are regional California maybe have more exposure to technology. I mean, it looks like, and people are saying that a lot of it is because they have long duration assets that have gone down in value on the asset side of their balance sheet. And then people are also taking money out, causing a problem. And then they didn't, so they weren't able to really, get the refinancing that they wanted without lots of people trying to take money out of the bank. But some of it's probably also due to the fact that the loans to technology companies in that area are a little bit riskier. I think the economy is still strong enough that I don't think they're having problems with those loans. But
Right.
Yesterday there were a lot of venture capitalists that when they did their update and started to talk about all of this, there were a lot of venture capitalists yesterday who told their portfolio companies to yank their money out of that bank.
Yeah, it's not a good sign when you start to see these things happen. And, what's interesting to me is the structure. I'm sure there's a lot of clients or people that listen to this that have a lot of questions. And it basically comes down to how they structured their balance sheet, right? Was the biggest proponent to this collapse. And they had, instead of structuring a lot of their debt on their balance sheet in shorter term riskless assets like treasuries, they had a larger than average exposure to long-term treasury assets. And even though they marked them to hold to maturity, when you have to start selling assets to fund withdrawals, you basically have to mark those assets to market. And a lot of those long-term treasuries were down pretty significantly last year.
Right. Take a loss. And so they announced that, and they wanted to do some additional equity financing to shore up the balance sheet. So that gets into like bank regulation and capital ratios and reserve requirements and all that kind of stuff. And the market didn't like that yesterday.
Now, if you were if you had your money at a regional bank that had similar exposure to that, would you be worried about your capital, maybe like a First Republic?
I don't know. I mean, that's a good question. I mean, it doesn't seem like things are really bad yet. But I mean, another way of looking at it would be to say, well, what's the reason to have your accounts there? If you do have accounts there, like, are you getting anything special for it? And if not, it might just be a good safety precaution thing to, move your accounts to a place that, you're really sure is too big to fail.
Yeah.
We feel like Charles Schwab, is really a broker and custodian focused on, independent investment advisory. And so they're not a bank that does all this kind of lending and has balance sheet risk and exposure. And among the larger banks, like there are some that have more kind of investment banking or risky loan exposure than others. Like the asset mix is all different based on the business lines that they have. So, there are certain banks like Wells Fargo and JP Morgan that are probably like way too big to fail, and then the other ones are all probably a little bit riskier in different ways. And then the regional ones, if they're tech focused, yes, okay, that's understandable. But if it was a regional bank that was more focused on just bread and butter like home loans, that might be pretty safe.
Right. Yeah. I mean, I even got an email today from a tech stack company that we use, uh, reassuring us that they don't, like a technology company that we utilize for software purposes, that they don't use SVB. So there's definitely some fear out there. But at this standpoint, if you don't have any capital at SVB, there's really nothing to be concerned about as of today. I think the market is taking it as, a contagion risk possibility, or maybe the start of a black swan event in the credit market. I think the biggest risk that a lot of these smaller banks have, is in what they're investing in, right? I think you and I talked about today how problematic commercial mortgage-backed securities can be at this standpoint, right? With a high level of vacancies. Specifically, if you have floating rate debt on those, where now you're having to refinance that debt at a much higher level. And then those banks have to mark to market those loans in the event that something's happening. But it's something that we've been talking about for a long time with our clients, this significant drop in bank reserves just over the last year. I mean, it's pretty astronomical, this drop in bank reserves, but that's because the risk-free rate of return in treasuries is so high. So people are pulling their money out of banks, investing it in short-term treasuries to get a guaranteed rate of return. But that can cause cracks in a system, specifically when net interest margins at banks has been declining as well, because they have to pay their depositors more money versus when they loan out that money before.
Right. Yeah. So that's what's at the root of this problem over at Silicon Valley Bank, is that the Fed's been raising interest rates. People have been shifting money around. Economy is slowing a little bit, and they are in a more risky position than other banks. And so they're starting to feel the effects of this. And so, yeah, there's concern that, there could be more events like this. So,
yeah. And just to add on to that, right? I mean, as the Fed's been raising rates, you saw a lot of startup companies get smacked last year. And, a lot of people saying they don't even know if the current valuations of a lot of those startup companies or VC-backed firms are even at a low yet. We heard that today. But VCs aren't writing the checks that they were 3 years ago or 2 years ago, right? Because of the failure for risk. So a lot of these companies are dwindling down their cash reserves even more, causing more withdrawals and lowering bank reserves, specifically in this case, SVB.
Yeah, money's not free anymore.
Right. But these aren't things, right? So this is what I get really upset at. These aren't things that you would see in a soft and definitely not a no landing environment, right? It's extremely frustrating to me when you see the talking heads come on from different institutions talking about this no landing environment when you've got all of these things that are happening. And you even now have a Federal Reserve that's probably more confused than Curious George.
Mm-hmm. Yeah, well, there are a lot of selfish, conflicted commentators out there.
Yeah.
And we're doing our best to be, blunt and objective about this.
Yeah. Well, just so everyone knows how it works, if it's an interest-bearing account, an account that bears interest, FDIC insurance covers up to $250,000 at a banking institution. If it is a non-interest bearing business account, it is unlimited protection, but you can think of the companies that may have money at SVB as a business. They have, semi-monthly payrolls that are due, accounts payables, and that money is basically frozen until the FDIC negotiates a takeover from another institution at this point, even though if it's in a non-interest bearing account. At a banking institution. So just wanted to pass that along too.
Right.
But
So people may not lose much depending on their situation as depositors over at Silicon Valley Bank, but their money's tied up until the FDIC works through it.
Yeah. So that mean you got to lay off people if you can't pay them?
That can take time.
Right.
Right. Or maybe they have to have a credit line with another bank to cover their expenses.
In the interim. Yeah. So these aren't things of a healthy, growing economy. And we continue to say that. So it's unfortunate for all the individuals over at SVB. Nobody likes to see anybody go out of business, but it is a part of capitalism. I'm going to jump into a few things, Carl. So I think everyone that's been watching us for, at least the last 6 or 8 months knows the position that we're in with regards to investing. We own a lot of short duration treasuries for the majority of clients' portfolios. And I saw this meme the other day that I thought was absolutely amazing. And it says he owns a portfolio of laddered short-term treasuries. And essentially what that means is it's probably the sexiest thing right now, right?
Are they shocked in a good way or a bad way?
Oh, they're shocked in a good way. Like, wow, I want to be with him because he owns a portfolio of laddered short-term treasuries. So I thought that was really interesting. And the reason I think that is essentially because, we've got this environment, and I was telling, a client this earlier this morning. And I said, okay, let's just imagine that we're going to potentially go into a recession over the next year. And the market has the possibility of going down, 20 to 30%. Let's just go right in the middle, 25. Do you think that in this environment, there's a high probability chance that the market's going to go up 25% over the next year or so? And if the answer is yes, then that's still only a 1-to-1 risk parity, right? Up 25, down 25. Even though the answer is probably no. But in that type of environment where you want to be taking equity risk, you want to look for the 2-to-1, 3-to-1 risk parities. And why short-term treasuries are so attractive is because what's the 1 year at today? Like 5.1, 5.2.
5.
Yeah, I was at almost 5.4 just yesterday.
Right. It's like all the treasury yields have dropped about 30 basis points today.
Yeah. But in this environment, you can now sit back, watch things unfold, and collect a competitive rate of return without taking any principal risk on those shorter duration treasuries, which is why I really like that meme that I just shared. But what I do want to talk about is what happened this week. So Jerome Powell, Fed chairman, spoke in front of Congress, and here's basically what he said. Peak rates will be higher than anticipated. Revisions show inflation higher than expected. Minimal deflation in services. Decisions to be made by meeting. And inflation, quote unquote, to be bumpy. So a pivot from hawkish to more hawkish is what it sounded like over the last 2 days. But when you get some systemic risk like SVB failing, now it's not as hawkish because there could be some cracks in the financial system. What are your thoughts on all of that, Carl?
Well, I've been watching it over here, looking at the CME Group's FedWatch tool and what the rate hike expectations are this week. And they did ratchet up after those conversations with Jerome Powell. And it did get to the point where, getting the Fed funds rate up to 550 to 575 by the summer was fully expected.
Yeah.
And there was probability that it would go higher than that. And now we're at the point where, we're not there. That's not expected anymore. Only 525 to 550 is expected. And, it's not, there isn't a lot that's expected beyond that. And maybe we get there. Yeah, maybe we get there in July.
Yeah.
It's amazing how like one event in a day can have such a big effect on what the rate hike expectations could be. But
well, I think the markets are testing Powell, right? Like, wait a minute. 2 days ago, we were expecting 50 basis points. Now the bond market is telling us, nope, that's off the table because of SVB, the collapse there. I think, I think the Fed is really stuck between a rock and a hard place. Clearly, what he said is 2% is their target. They've got to bring inflation down. But you're starting to see, even in the banking system, the effects of these higher rates on what it's doing to their balance sheets. And the problem is that if he takes inflation easy, that's almost worse than raising rates.
right. Yeah, I mean, having inflation elevated doesn't make the economy work for people. It also adds a lot of interest expense.
Yeah.
Having rates go up also adds a lot of interest expense to the government, and as we're seeing, put stress on bank balance sheets like this. So yeah, I mean, you can't really live in an economy with ongoing inflation, um, because it just creates a lot of problems, with no price stability.
Right.
You don't know what things are going to be. It kind of distorts demand, distorts the labor market. It's not good for savers or people trying to retire. I mean, in general, historically, you've generally had cash interest rates be a little bit higher than the inflation rate.
Yeah.
So that's where we have to go one way or another. However jagged the line or the path is to get there. But it's becoming clearer, that you know some things are going to have to break for that to happen. And
Right.
today a twig snapped.
Yeah. Twig snap today. I thought it was hilarious. I don't know if you've seen any of the testimony, but there were members of Congress grilling Powell about, the unemployment rate potentially going up to the tune of, 1.5 to 2 million jobs is what the Fed would inevitably expect. I think that they put a report out and they were saying, well, at what cost? So you're going to keep raising rates so that, 1.5 to 2 million people lose their job. How does that make you feel? And he whipped right back at him and said, ma'am or sir, I don't remember who he was talking to. Inflation is worse, right? Sustained price inflation is worse.
Yeah, it's worse. I mean, not for people who don't have any savings, but for someone who does have savings and or is trying to live off of it, it ultimately affects their demand and consumption patterns a lot, because you need to then earn a certain amount just to keep up with inflation. And even right now, we're not really doing that, especially like on an after-tax basis.
Yeah.
So that's another reason why you've got to have interest rates above inflation. Really, like the cash interest rate should be above inflation, to the tune of however much the average person's tax rate then brings the return down to what inflation is, right? Like it kind of makes sense that there should be no real return on cash.
Yeah.
And then, you get real return for taking risk and other things over time. And we're just not there yet.
Yeah.
Because think about it, like if you had some savings and you were trying to live on it, I mean, and you're not getting as much income as you need to keep up with the prices going up at the grocery store, et cetera, your consumption is going to slow.
Right.
So, I mean, that's another way that markets have of making the adjustments in the economy, whether the Fed does what they're supposed to do or not. The bond market adjusts.
Unless you have a credit card.
Consumption patterns adjust. But yeah, even if people have credit cards and they borrow, if they borrow too much, then that creates problems too. And maybe there will be, more personal bankruptcies, or they just will stop consuming.
Well, we have some bankruptcy attorneys as clients, and they tell us that the federal laws from COVID that were put in place are really hampering their business because it's delaying bankruptcy filings, specifically on car loans, things like that. So yeah, but just to put it in perspective, 981 billion, call it $1 trillion of credit card debt, most in history. The average APY on a credit card now is 24% because of how high interest rates are. The average new car loan is 8.9. The average used car loan is 13.7. And I just read an article in the Wall Street Journal of a gentleman who bought a used car just coming out of the pandemic when prices were really spiking for 70,000. And today it's only worth about 51. That's how That's how much of a pandemic price hike was put into that used car. And this bank, whoever it was, issued out this loan for, 65,000, whatever it was. And they're only sitting on a depreciating asset that's worth like 50 grand. And that happened thousands of times over the last 2 years. Right. So these just aren't things where and I'll say it again, that you see in a soft or no landing environment. The problem is you don't know when that landing is going to occur. But with regards to that, pull up an awesome chart. So what this chart looks at is basically the S&P 500 going back to the 1950s, unemployment rate in
wait,
orange.
do you have the chart up?
I have it on the wrong screen. Sorry.
Yeah, I just was looking at your desktop there.
How about now?
There we go.
There we go. Thanks, Carl. I did this once where it was just me. And for the whole 5 minutes, I was sharing just the desktop screen. So thank you. But here we've got a chart of the S&P 500 going back to the 1950s, unemployment in orange, basically stating that the stock market bottoms only after the unemployment rate actually rises. So for the people that are calling that October low the bottom, history isn't a really good predictor of that.
Yeah, there's no way that was the bottom in this bear market for that reason, but also because the Fed hasn't started easing yet. They're continuing to tighten.
Right. Yeah.
All these big bottoms in bear markets happened after they had done a lot of rate cutting and a lot of easing, and they don't generally do that until the unemployment rate is shooting up.
Right.
And it's obvious that, okay, you're in a recession, there's a problem because you have all these people losing their jobs.
Well, and we've talked about this, right? We've talked about the fact that, it's really difficult to compare the Fed's moves in the 90s, in the 2000s, or the early 2000s, 08, and COVID on how they typically cut rates prior to the recession, because inflation wasn't really a abnormal problem then. But you've said multiple times, if you look back to the 70s and early 80s recessions, the Fed didn't actually start cutting rates until partway through or midway through the actual recession.
Yeah, basically, when the Fed started cutting rates, that was when bond yields peaked, and that's when stocks also bottomed.
Yeah. So just something that we saw come across our desk, we wanted to show people. And before we close out, Carl, I wanted to talk about one way to pay for all of this debt that we have. Do you know what that one way to pay for all this debt that we have?
Which way other than inflation?
Taxes, baby.
Yeah.
You got to increase taxes. So the president just released his budget plan. Obviously, it's got to go through a number of iterations and changes as it goes through the House and the Senate. But here are some big takeaways on how they plan on paying for the budget that they just released. So a 25% billionaire tax, raising the corporate tax rate from 21 to 28, and a tax on income over 400,000 of 39.6, as well as basically doubling the capital gains tax rate from 20 to 39.6. Now, let me ask you this question, Carl. If I told you that capital gains was going to go to 40%, do you think that would disincentivize you to own stocks?
No, I don't think it would affect anything, but if I had a lot of unrealized gains, I might want to start realizing them before the rate went up.
See, that I disagree, though. I think for a lot of people, there would be a huge disincentive as using equities as a vehicle for savings if it wasn't in a tax deferred account, knowing that you're going to lose 40% of that to Uncle Sam if and when you sell those positions.
Yeah, that's true. I mean, at the margin, people are going to favor fixed income if there is a good enough return over in that as well. But they
So,
might look for other things,
yeah,
as well. But like the bigger question with all those proposed tax increases is how much revenue would they actually raise?
right.
So the problem is that like if you ever go into your tax forms and you look at the pie chart on all of that and where all the revenue comes from, the tax revenue, like most of it is like personal income taxes.
Yeah.
There's a small piece of the pie that is corporate.
Yep.
But yeah, the big majority is personal. And there isn't, these kinds of like billionaire taxes, like there aren't that many billionaires. So like you're not gonna get much money out of them. Like every time I've like, looked at this stuff and had conversations with people about all of this, it kind of degenerates to, well, yeah, I mean, it might be politically expedient to have these kinds of taxes, but and people may like it, some like 50 to 60% of people or more, or maybe 90% of people like may like it, but it doesn't raise that much revenue. And ultimately, if you want to raise a lot of revenue, I mean, you just have to raise taxes on the middle class.
Yeah.
And that's probably where things are going to have to go ultimately.
Eventually. Yeah, well, that's what they did back in the day, right? They just expanded the brackets that was more inclusive to people at higher rates all along the lines.
So I mean, you could look at the income tax and sort of the tax bracket history in the United States. So around when the Federal Reserve was created, the income tax was invented, like 1913 or so.
Right.
And then what happened? Like we had World War I, and then they invented all these like big tax brackets at high levels.
Yeah.
And it got even worse, like with World War II, and it sort of stayed that way until
it's like 70 or 80%, something like that.
Right, exactly. Like you had like tons of tax brackets. Like today, it's relatively
we got it easy now, then,
low.
right, man?
But you had all these really high tax brackets where it would be like over like $500,000 or like $1 million in income. The tax rate would be like 60, 70, 80% or whatever. And that I don't think that got abolished until like the early 1980s when Reagan got into office, and they got rid of all that stuff. And basically the tax framework that you have now is kind of is more or less like that. I mean, like at times they increased the top rate and all of that, and or they moved it down, but it's basically been more tax friendly the last like 40 years.
Yeah, well, when they increased the Medicare surtax on individuals making over a certain income that adds to capital gains, that was only a 3.9 or 3.6%, 3.8,
like
3.8% increase. They're talking going from 20 to 40, right? Like it's interesting, but we have to stay on top of it because it affects a lot of advanced planning that we do for clients. So, all right, Carl, I really appreciate your time, sir. I know it's really valuable, but when we get some big news out there, we want to make sure we're staying out in front of people. So hopefully we'll see you again soon, and have a great weekend.
Yeah, thanks for joining us. Thanks for taking the time, Andrew.
All right, bye.
Bye.
All opinions expressed by Andrew Whalen, employees at Whalen Financial, or any other podcast guest are solely their own opinions and do not reflect the opinion of Whalen Financial. Whalen Financial is a registered investment advisor. This podcast is for information purposes only and should not be relied upon for investment decisions. Clients of Whalen Financial may maintain positions in the securities discussed in this podcast.